Are you a first-time homebuyer new to the home buying process and wondering what it takes to get approved for a loan to purchase a home? Well, in today's video, we're going to go through the conventional loan requirements for 2022. We're going to touch on everything from credit score required to down payment to what you need with regards to employment and job status. And we're also going to touch on how much income you need to make versus how much debt you have to give you an idea of whether conventional loan is even a good fit for you. Now, the one thing I want to point out early in this video is conventional loans are usually a little less flexible than other types of loan programs out there, like FHA loans or VA loans. Now, conventional loans are not backed by the federal government, again, like FHA and VA. Therefore, their requirements are a little more strict when it comes to qualifying. So if you don't qualify for a conventional loan, you might try one of the other loan programs out there because typically they allow higher debt to income ratios as well as lower credit scores. But for today's video, we are going to talk about conventional loans, and towards the end of the video, we'll talk about FHA and VA and USDA and some other types of loan programs just in case conventional loans aren't a good fit for you. Now, typically when talking to first-time home buyers, they want to know what credit score they need, they want to know what down payment they need, they want to know how much income they need to make in order to purchase a home. So that's really where we're going to focus our attention today. And we're also going to address some commonly asked questions that first-time home buyers have when going through the loan process in order to kind of make this an all-encompassing video so that you have a really good idea of what's required when you're ready to start that home buying process. Now, the very first thing I want to touch on in today's video is credit score, because credit score seems to be the one piece of the puzzle that either, gives you an opportunity to buy a home or completely throws you out of the process altogether. And conventional loans, while they're flexible on their credit scores, they do have a minimal credit score of 620 in order to use conventional financing. So that means if you have less than a 620 credit score, conventional financing probably isn't going to work with you. Now, one thing you need to understand about lower credit scores like 620 is that with conventional financing, you're typically going to have much higher interest rates. You're going to have much higher mortgage insurance when you put less than 20% down. And we'll talk about mortgage insurance and down payments here in just a minute. But the lower credit scores tend to get hit with much higher fees when doing conventional financing versus, an FHA loan for that matter. So if you do have lower credit scores, just understand you're likely going to pay a much higher interest rate and much higher mortgage insurance premiums every single month because of that credit score. So it might be in your best interest to try to get that credit score up so that you can get much more favorable terms if you're considering using a conventional loan. Now, one thing I want to point out in the environment that we're in right now, lower credit scores can be more of an issue, more of a hurdle, if you will, with some lenders out there. They might have overlays on their programs that don't allow certain credit scores. You might go into a bank per se, you might go to a credit union, and they might say, well, because you're below a 640 or a certain number, you can't get a loan. Just understand that's their guidelines, not the actual guidelines put out by Fannie Mae or Freddie Mac. So if you're getting a no, just understand that there might still be an option for you if you meet all the other requirements of this loan, which we're going to talk about here in just a minute. Now, one thing I want to point out, and a lot of people have questions about, is where do you start? If you're looking to get a loan, do you go into your bank? Do you talk to a credit union? Both of those are good sources, but they usually have overlays on their programs. I would recommend talking to a mortgage broker, someone that has access to multiple lenders, may even have access to the bank that you went into or the credit union you went into, because typically their terms are a little bit more favorable. Their rates are able to be shopped quite a bit more because they can go out to different lenders. They have different guidelines sometimes than those of banks. And if you need a lender, you're having questions about where to start, do me a favor, check out this link below. I'll connect you with a lender who does conventional financing and can also compare your loan against FHA or USDA depending on where you're located in the country so that you have a really good idea of whether or not conventional financing is even the best loan for you. They can compare you against all of them. So that link will take you to a mortgage professional and get you connected if you don't have one that you know, like, and trust. Now, the second thing I want to touch on in today's video is down payment, because outside of credit score, down payment is usually the biggest concern for most first-time home buyers. Now, conventional financing, they only allow a 3% down payment. Now, usually 3% down payments are associated with first-time home buyers. In this case, any buyer can use the 3% down option as long as they meet all the other requirements with regards to conventional financing. Now, understand you can use this loan more than one time. That's something that I do want to point out. You can get as many conventional loans in your lifetime as you want. You're not restricted to a certain number. The 3% down option is for anyone, not just for first-time home buyers. But one thing to keep in mind, with that 3% down option, you are going to have a higher interest rate than those putting more money down. And if you have a lower credit score and you're putting only 3% down, you're likely going to pay a premium across the board in order to get that loan. That's why it pays to have a bigger down payment. It pays to have higher credit scores, because typically those loans offer much better terms all the way around. But conventional financing does allow a 3% down option. Now, keep in mind, something I mentioned a moment ago is that you're going to have mortgage insurance. When you put less than 20% down and you purchase a home, you have something called mortgage insurance, PMI. Essentially what it is it's protection for the lender in case you default on the loan. It's like a monthly insurance that you pay every single month when you put less than 20% down on that home. Now, I often get people asking, if I pay my balance down to 20%, or my home appreciates by a certain amount and now I have 20% equity, can I get rid of that mortgage insurance? And the answer is yes. You can absolutely get rid of that mortgage insurance once you have 20% equity in that property. Now, I don't want to get into all the nuances of refinancing or the mortgage insurance falling off, but if you have questions, do me a favor, put them in the description below and I'll get back to you with the answer on how that works. But you get 20% equity in that property, it falls off. Now, I also get people asking, well, can I just pay a fee up front not to have mortgage insurance? The answer is no. Every single loan putting less than 20% down is going to have mortgage insurance. Now, you will hear some lenders out there say, well, we have a loan where you put less than 20% down and you don't have mortgage insurance. Just understand it's built into the interest rate. You are paying for that mortgage insurance in some way, right? It may not be a separate fee that shows up every single month, but you're likely getting a much higher interest rate to cover that mortgage insurance, which may mean that you're paying even more than you would if you just paid the monthly mortgage insurance by itself. So just understand, when you're getting a conventional loan, you're putting less than 20% down, you're going to have PMI every single month on that loan until you have at least 20% equity in that property. In addition to the 3% option that you have when using conventional financing, you can also put 5% down, 10% down, 15, 20, 25, 30, any amount you want down above and beyond that 3%. Now, typically speaking, the more money you put down, the higher your credit scores, the more favorable the terms are going to be with that loan. So just keep that in mind when you're going through the process. Now, the third thing I want to talk about today is debt to income ratio. What is debt to income ratio? It is how much monthly debt you can have versus how much income you make in order to qualify for a loan. Now, if that sounds really confusing, understandably so, but just understand there is no certain amount of income that you need to make to own a home, but you have to meet certain debt to income requirements in order to qualify for a conventional loan. Now, I'm going to walk you through an example here to give you an idea. Now, the conventional loan requirements for DTI is 43%, which means that you can't have more than 43% of your monthly debt going toward housing expenses and credit card expenses, car payments, all of those expenses every single month. Now, before we dive into what that actually means, just understand that number is a bit flexible. I have seen it go as high as 48, 49% for conventional loans and get approved, but that's usually when, the client has excess money in the bank, putting a large amount of money down as far as the down payment goes, and also has high credit score. So if you have all of those things, chances are that number is probably a little bit flexible. But if you're on the lower credit score side, the lower down payment side, you're likely going to be stuck somewhere around that 43 to 45% debt to income ratio. Now, let's take a minute here and talk about debt to income ratio to give you an idea of how it works if you're completely confused by my statement a moment ago. How they calculate it is they take your gross monthly income and divide it by your monthly debts, including your housing expenses. So let's say, for example, you make $120,000 a year, just because it makes simple math. That makes $10,000 a month. So your gross monthly income before taxes is $10,000 per month. Now, let's say you have a car payment that's $1,000 per month. You have a credit card bill that's a $500 minimum monthly payment. You have student loans for $500. So that's $2,000 per month that you have in monthly debt. Now let's say that you're going to buy a home and the mortgage on that home is roughly $2,500. So that means you got $2,500 for the mortgage, you've got the $1,000 for the car, the $500 for the student loans, the $500 for the credit card. So you're at $4,500 per month in total expenses. Well, if you divide that by 10,000, which was your gross monthly income, you're at a debt to income ratio of 45%. Now, as I mentioned a moment ago, 43% is the cap. Now, there are times when that number can be flexible, as I mentioned, but in this case, you might be above and beyond the allowable debt to income ratios in this example. So that may or may not be doable based on other circumstances in your loan, your credit score, how much money you're putting down, all that stuff I mentioned a moment ago. But that's essentially how debt to income ratio works. Now, one thing I want to mention is it's super important that you work with a professional when going through this process. Don't just call the call center online or get the number off, the radio ad and call to see if you've been pre-approved. Talk to a mortgage professional, someone that knows the business, understands the business, has experience, and can guide you through the process. And if you're talking to someone on the phone and they're just asking you questions and you're not providing any documentation, understand that's not a real qualification. You need to fully be pre-approved, which means that you need to provide bank statements, tax returns, W-2s. They're going to run your credit in the process to see exactly how much you can afford to purchase. Now, that is what a pre-approval is, and it pays to work with a professional. Now, if you need one, I did put a link in the video earlier, and I also have one in the description below, so check that out if you want to get connected with someone that can guide you through that process. And another thing I want to talk about in today's video is loan limits. Conventional loans only allow you to borrow so much money depending on where you're located in the country. Now, there are areas that are considered low cost, and there's areas like California, where I am, that are considered high cost. So depending on where you're located in the country will determine how much money you can borrow using conventional financing. Now, what I'm going to do is throw the loan limits up here on the screen. I'm going to throw the low cost areas as well as the high cost areas so that you know exactly how much you can borrow in those areas. Now, understand, this isn't the purchase price. This is how much you can borrow. If the max in your area is $647,200, which is, the low cost max loan limit, then that means that's the max you can borrow. If you wanted to buy a $700,000 home and you have the difference, for the down payment and you qualify, then that means you could qualify for a conventional loan. This is just the max that they'll allow you to borrow from the bank when doing a conventional loan. Now, as I mentioned a moment ago, the low cost is $647,200. What the 2, 3, and 4 means there is that if you were to buy units, if you were to buy 2-unit property, that has a higher loan limit than just 1 unit. If you were to buy 3 units or 4 units, you have a higher loan limit. So if you're planning on buying a multi-unit property, you can actually borrow up to $1,244,850 for a 4-unit building. Now, I often get people asking, well, what are units? It's when you buy a multi-family property, right? I would say when it has 4 doors, right? 4 front doors on a property, that's a 4-unit property. It's kind of hard to explain. We have a lot of them here in Southern California, but it could also be 4 single-family homes on one lot. That could also be considered a 4-unit property. Typically, how these are structured is you live in one and rent out the other 3. So if you live in a multi-unit property, say a 4-unit, you live in 1 unit, rent the other 3 out. And one nice thing about that is you can actually use the income from those other 3 units in order to help you qualify for the mortgage, which is really nice. Now, I'm going to talk about this more in just a minute with regards to investment properties and conventional financing, but I also wanted to touch on the loan limits for high cost areas like where I'm located. So the high cost for conventional financing for 1 unit is $970,800, and it goes all the way up to $1,867,275 for 4 units. Now, what I mentioned a moment ago is investment property, right? People often ask, can I use conventional financing and buy investment property? And the answer is absolutely yes. It just requires a larger down payment. I think the minimal for an investment property at the moment is 15% down, but the terms are not going to be favorable at all. Typically, you want to have 20 to 25% down. 25% is usually what I recommend, just because the terms are more or less the best that conventional is going to offer when you have that down payment. And the last question I want to answer with regards to investment properties, people often ask, well, if I live in it as my primary for a period of time, can I eventually turn that property into an investment property at some point in the future? And the answer is yes. Yeah, if you buy conventional financing as your primary home, you live in that home, you can turn it into an investment property after, say, a year of living in that home, which means that you could go out and get a new loan, conventional financing on the next home, house hacking, if you will. A lot of people out there are considering doing house hacking, and you can do that with conventional financing. Now, the last thing I want to talk about in today's video is income and employment, right? We've had a lot of craziness over the last 2 years with regards to the pandemic, people losing jobs. So it's important to know what's required if you're going through the home buying process. Typically, lenders want to see 2 years of employment, consistent income. Now, I know during this, last 2 years, people have been laid off, people have taken absences from jobs. Lenders are a little bit more flexible these days with regards to, these different circumstances. So it pays to, to run these scenarios by a lender just to make sure that you meet qualifications. But what they want to see is, typically you in the same line of work for a 2-year period. What that means is, if you're in sales, they want to see you in sales for a 2-year period. If you've been, a school teacher, you're essentially a teacher, for a 2-year period. Now, what they don't like to see is going from a W-2 job where you're a paid employee to being self-employed, unless you have 2 years of self-employment, right? There's a lot of little nuances in there, and that's why it's important to work with someone that understands what they're doing. And then also it comes down to income, right? Can your income fluctuate? Absolutely. But typically you want to see consistent income during that same period. They're usually going to want to look at 2-year history of income, either verified by W-2s or tax returns. In some cases, they want to see both, especially if you're self-employed, and they want to see that income pretty consistent. It can increase, but they don't like to see huge jumps in income either. Now, it doesn't mean you can't qualify. It just means it might be calculated in a different manner. So understand, when getting approved for a loan, not only do you have to meet the requirements that I mentioned, a moment ago in this video, but they're also going to want to verify that information by looking at pay stubs, W-2s, tax returns, bank statements, right? That's another important one. They want to see where the money's coming for the down payment, for the closing costs. There's all these different little nuances in when getting financed that you're going to have to verify, and that's just part of the process. And another thing, I'd like to ask a favor. If you found any value in this content at all, do me a favor, hit the thumbs up. Feel free to share it with someone you know that might be buying a house using conventional financing. And feel free to hit the subscribe button if you want to stay updated on information like this, like loan programs, as well as housing market updates to keep you up to date on everything with regards to real estate. Now, earlier in the video, I mentioned, giving you loan requirements for FHA loans, VA loans, and USDA loans. And in order to keep this video short, what I thought I would do is just throw a link in the description below to each one of those videos so that you can have an idea of what each one requires without me shortening them here in this video. And that way you can find out which loan is the best for you. And also, if you're watching this now and you're wondering which loan is cheaper between FHA and conventional, there's a lot of misinformation out there. Do me a favor, check out this video here. I dive into it in more detail, show you some examples for different credit scores to show you which one is actually the better loan in a couple of different scenarios. But for now, I appreciate you taking the time to watch. I appreciate the support. Hope to see you again soon. Have a great day. Bye-bye.